Hello everyone, welcome back to All Financial Discussion channel. For this video, I'd like to explain what is actually option. Okay, so options in fact is widely used in our investment. So therefore, it is very important for a beginner to fully understand what is actually option. Under this option, there are actually two types, call option and put option. This video, I'm going to highlight the key difference between these two options, call and put options. Under this call option, we actually have long call and also short call. Under the put option, we have long pull and short pull. This video somehow, I feel that long call and long pull is much more easier to understand. So therefore, I will kickstart the discussion on long call and long pull before we go into short call and short pull. Basically, all this will be the objective of this video. Guys, if you're keen to know more about financial discussion, please see the playlist under the description. Before I continue, I'd like to urge you guys to help me by like this video. Just give me a few seconds. Press the like button now. For those who are new to this channel, and if you want to encourage me, please consider to subscribe and turn on your notification bell. Once again, thank you so much for strong support. A quick disclaimer, I am not a licensed financial advisor. The content in this video is for entertainment and education purpose only and should not be considered financial advice. In this video, I'm simply showing you what I may be doing. Please conduct your own independent research and consult a professional if needed before you commit to an investment. Never invest more than you are willing to lose, and always be sure to read the fine print and the terms and conditions before you commit to an investment. With this, we are ready to start. I'd like to kickstart the discussion by doing a comparison between option and stock. I believe most of you guys actually understand what is actually stocks. Maybe option, okay, actually quite a handful of you guys are actually still confused what is actually option. So therefore, I like to compare the difference between option and stock. From here, you can see that this is actually in green. This means that the option has the advantage. Over here, you can see that these are all in green, which means that the stocks actually has the advantage. For a savvy investor, basically he will apply these two methods simultaneously. He will apply option and also stock. So therefore, it is very important for you guys to understand what is actually option, and you will be able to see the difference between these two, option and stock. Let's get started. Option. Option is actually a contract that let you bet on the direction of stock price. In short, option you can bet whether the stock price rise or the stock price actually drop. Basically, you have this flexibility. As for stock, okay, basically stock is actually the share of the ownership in company. The only way that you can make profit is when the share price actually rise or increase. So therefore, you can see that option actually has the flexibility because you can bet either it rise or it actually drop. Next, for option, okay, you basically can trade with relative lower capital outlay. Okay, so option is actually called premium. Okay, so later on you will be able to understand premium. Okay, but in short, you don't need a high capital under this option consideration. But for stock, typically you need a higher upfront capital because you need to buy the share. And typically a share actually require much higher capital as compared to option. For option, basically the disadvantage is it actually has a higher risk as compared to the stock. So in short, there is always a potential that you are going to have a unlimited losses. So this is very drastic. So therefore, you must be very careful when you actually choose to so-called invest under the option. For stock, actually has a lower risk. The only loss or maybe the worst loss is actually the stock price actually go to zero, which means that whatever that you actually invest, all the amount actually goes to zero. So this is actually the loss, the highest possible loss under the stock. For option, it actually has a shorter time frame. Okay, basically it can be in terms of hours, in terms of days, in terms of months. I think year is very rare. So basically from the option, you can have hours, days, or even 1 month, etc. As for stock, it's actually a long-term investment. Okay, so in short, you can hold them infinite. Okay, you can just hold as long as you want. Next, for option, okay, you actually has the flexible. Okay, so you are not obliged to add on the contract. Okay, so for example, you actually say that you want to buy, but end of the day, you may not be buying. Okay, so basically, this is what you want to say. But for stock, you definitely need to buy first before you own the share. So therefore, it actually has lesser flexibility. So in short, you can either choose to buy the share, hold it, or sell the share. Option is basically best for experienced trader. Okay, so you need to have some form of understanding before you actually can come into option. As for stock, actually is suitable for most investor level. Okay, so basically this is mainly for beginner. Like I mentioned earlier on, okay, for a very savvy investor, you definitely will apply these two methods, okay, in order to achieve financial independence. So therefore, it's always very important to understand what is actually option. Okay, so a very simple example. Okay, so I like to explain option in our daily life example. Okay, so the simple analogy is basically a coupon for a future purchase. Okay, so imagine this. Okay, so imagine you see a house that you think that you may want to buy, but definitely you are not 100% sure yet. Basically, you will go to the seller and say, okay, I will give you $5,000 today. In return, can you promise me that I can buy this house for 500K anytime in 30 days? Okay, so if I decided not to buy it, I walk away and you actually can keep the $5,000. Okay, so this is actually an option. Okay, so basically you have just create an option. Okay, the $5,000 is what we call the premium. Okay, so basically this is the cost of the option. Okay, the cost of the option is basically this is a premium that we actually need, okay, to buy or to sell. Next will be the right to buy. Okay, the right to buy is actually the house. The house is actually the asset. Basically, the seller and the buyer has the right to buy or the right to sell. Basically, this is what we know as the option itself. The 500K is actually known as the strike price. Basically, this is the price that is actually agreed between the buyer and seller. The 30-day periods, okay, basically will be the time until expire. Okay, so basically we create an option. Okay, the expiry date for this option will be 30 days. So from here you can see that we can actually correlate this with our so-called daily life example. Okay, so in short, this is actually what we know as the premium. Okay, so basically this is what we know as deposit. When we actually want to see a house, when we want to buy the house, we put a deposit. Okay, but finally, if let's say we decide not to buy the house, the deposit will be forfeited. Okay, there will be a duration, let's say 30 days. Okay, so basically this is a price that we actually agreed, okay, to buy the house, the buyer and seller. Okay, so basically this is the right to buy the asset, which is the house. This is the strike price, something that you agreed between the seller and buyer. This is the so-called the time, okay, that the option actually expire. This is the core concept of an option. It is a contract that gives you the right but not the obligation to buy or sell an asset at a predetermined price by a specific date. Okay, so let me give you more example. Okay, so in finance, okay, an option is a derivative contract that derives its value from an underlying asset. Okay, so this asset can be a stock, can be a ETF, index like S&P 500, a commodity like gold or oil, or even a currency. Okay, so as I mentioned, there are actually two fundamental types of option, okay, which is the call option and the put option. From here, you can see that the call option is further divided into long call and short call. Same for the put. Basically, they can be further distributed like long pull and short pull. Like I mentioned earlier on, somehow the long call and long pull will be easier for us to understand. So I will explain the long call and long pull first before we come into the short call and short pull. Let me quickly so-called explain the difference between call option and put option. Imagine this scenario. Okay, so basically this is a buyer, this is a seller. Okay, this is something that they actually agreed, okay, to buy or to sell at a predetermined price, okay, at a certain time duration here. So what is actually a call option? Okay, so call option is mainly for buyer. Okay, basically they will give you the right to buy. Okay, the buyer the right to buy this, okay, underlying asset at the strike price. Okay, so basically you agree between the buyer and the seller how much this thing will be. So basically this is what we know as the strike price, of course with a duration also. Let's say, okay, 3 days, if you are not satisfied, you can actually go back to the seller. Okay, so you buy a call when you are bullish. Okay, so when you actually think that the share price will increase, then you will buy a call option. Okay, because you believe the price of the asset will go up. Okay, so basically in short, for call option is the right to buy, and you actually buy a call when you think that the stock price will be bullish. Put option. Okay, so this give you the rights to sell. Okay, so this is actually in the position of seller, the right to sell. Okay, the underlying asset at the strike price. You buy a put when you are bearish. Okay, you believe the price of the asset will go down. Okay, so basically from here you can see that if you think the price is going to increase, okay, you will select this call option. If you believe that the stock price will drop, then you will actually select this put option. Okay, so basically this is a quick explanation on call option and also put option. In order to fully understand this option, okay, we need to know, okay, all these key terminology. Okay, so basically this is what we know as the underlying asset. Okay, for example, just now I give you an example of a property. Okay, so the property is actually the underlying asset. Strike price, okay, basically will be the fixed price at which you can buy or sell the asset. Okay, so this is a price that the buyer and seller actually and so-called agreed. Okay, so basically this is what we know as the strike price. Expiry date. Okay, so this will be the last day the option can be exercised. Okay, so basically after that, okay, you can't do the exercise anymore. This is actually the expiry date. For example, 30 days. After 30 days, okay, the contract is not valid anymore. Premium, okay, the price that you actually pay to buy the option contract. Okay, so don't confuse this, okay, as compared to the strike price. This is actually the price that you actually agreed when you actually buy the option contract. Okay, I think later on with an example, you will be so-called in a better position to understand the word premium. Contract size. Okay, so one standard equity option contract typically represent 100 shares of the underlying stock. Okay, so basically in short, okay, basically one standard is actually represent 100 share. Intrinsic value, okay, the immediate profit if the option were exercised now. Okay, so basically this will be for a call, okay, a $50 strike. This is something that you agree. So let's say the stock price is 55. So the intrinsic value is actually the current stock price minus away the strike price. Then you actually has an intrinsic value of $5. Okay, I think later on with an example, you will definitely able to understand this six terminology. Let's quickly kickstart the discussion on long call, okay, which means that buy a call. Okay, action. Okay, you actually buy a call option. Okay, why? Okay, the outlook is because you think that the share will be bullish, then you actually do this long call. Okay, you believe the price of the underlying asset, okay, for example, a stock will rise significantly. Okay, what is your right and obligation? Okay, you have the right to buy. Okay, remember, as I explained earlier on, this is actually in the position of buyer. Okay, you have the right to buy the stock at the strike price before expiry. Maximum profit, okay, theoretically unlimited because the stock price can go on and on and on and on. Okay, so therefore there is no maximum profit. As for maximum loss, okay, basically the maximum loss will be the premium, okay, the cost of the option. Okay, this is actually the so-called very attractive because you only lost the premium. Why you're going to do this? Okay, basically is to speculate on a price increase with limited risk and high leverage, or to lock in a future purchase price. Okay, so this is actually for long call. Before I continue to give you an example of long call, urge you, if you have learned something from this video, urge you to support me by like this video. Guys, just give me a few seconds. Press the like button now. For those who are new to this channel, and if you have learned something from this video, help me by subscribing to this channel and turn on your notification bell. So now we are ready to have a long call option example. Okay, so the example will be the DBS. Okay, so we are going to apply the call option. Okay, in case for those that are not in Singapore, this is actually a Singapore stock market price, a stock bank stock. Okay, so it's actually known as DBS. So basically, I will give you an example on DBS call option. Okay, so basically, DBS is actually the underlying asset. Okay, so just now was a property, so now it's actually the share price of DBS. Current stock price, for example, let's say that DBS is currently trading at $55. Okay, you actually activate this call option purchase. You buy a call option, okay, with a strike price of $57 for a premium of $1. Okay, so the option going to expire in 14 days. There are actually two possible scenarios. Scenario one, okay, remember as I mentioned that DBS current trade is actually at 55. So just imagine this. Okay, so sometime later, let's say the stock price actually increased to 62, from 55 to 62. Okay, at expiration, okay, you can actually exercise your right to buy DBS share at the 57 strike price. Okay, so remember, this is a price that you actually agreed between the buyer and seller. Even though the stock of DBS actually rise to 62, you have the right to buy at the cost of $57. So for example, this is actually the buy the 100 share. This is what we know as the contract size. Okay, basically will be at $57. Immediately, you can actually sell them at the market price. Okay, so now the market price is actually 62. So the gross profit per share is actually 62 current market share price minus 57, okay, which is your strike price, is equals to 5. Okay, so this $5 is actually the intrinsic value. Next, I'm going to calculate the net profit for you. Okay, this is actually the intrinsic value, which is 5. Okay, you need to minus off whatever premium that you need to pay. So from here, you can see that your profit is actually $4 per share. Okay, so basically this is under the scenario one. Okay, remember when you actually want to buy this call option, you actually think that the market is going to be so-called going to perform. So therefore, from here you can see that from 55, it actually rise to 62. And you can see that you actually has a profit of $4. Now another scenario. For example, the stock price still stay below 57. Okay, basically this is the strike price that you actually agree, okay, with the buyer. So since the stock price is at or below $57, okay, before it actually expire, okay, so it is not profitable to exercise the option. Okay, you will let it expire worthless. So your total loss is limited to the premium that you actually pay, which is $1 per share. So basically from here you can see that you actually limit your loss. Okay, so basically your loss is basically $1. Okay, so this is actually the maximum loss for this long call option. The break-even point, okay, the trade become profitable at expiration when the stock price move above the strike price plus the premium pay. Okay, if you still remember, the strike price is $57, the premium is $1, which means that this is actually the break-even price, $58. This means that you start to make a net profit only if DBS is trade above 58. before it actually expire. Okay, so basically this is a very easy example on a long call option. In short, let me do a quick conclusion. Okay, so for example, when you actually buy, okay, the price is actually at $55. Okay, so the strike price is basically what you agree with the buyer and seller. Let's say it's $57. Premium that you guys actually agree is $1. The break-even point will be equal to the strike price plus the premium, okay, which is 57 plus 1, which is 58. So let's say what is the possible profit, maximum profit? Okay, because the stock price can go on and on. Okay, so imagine it was 55, it can be 100, it can be 1,000, it can 1 million. Okay, so this is what I mean. But we know that this is not realistic. Okay, so basically we want to discuss on the maximum profit. Okay, so therefore this is why I say that it's unlimited, depend on how the stock actually rise. But in general, let's say the stock actually increased to 62. Okay, so you can see that just now how I calculate is basically you are going to have a profit of $4. Okay, basically will be the strike price. Okay, the strike price. Okay, 62 minus away the strike price. Okay, which is $5. $5 minus the $1. Okay, for the premium, this is actually the maximum possible profit. As for the maximum loss for this long call option is $1, which is your premium, because anything, okay, so-called at 57 or below 57, you are going to walk away. You are not going to honor the contract. So the possible maximum loss is actually the $1 per share that you actually agreed with the seller. The intrinsic value at 62, okay, will be $5, and basically this is what I have mentioned earlier on. Okay, so if you talk about the profit, okay, basically you will be using the intrinsic value minus the premium, which is $4. Okay, so basically this is a summary of your long call option. Next, I'm going to discuss on long put. Okay, so basically this is you buy a put option. Okay, so why you buy this long put is because you think that the market will be bearish, which means that the stock price will so-called reduce, will coming down. Okay, you believe the price of the underlying asset will fall significantly. Okay, what is your right and obligation? You have the right to sell. Okay, so basically now this is a position of a seller. You have the right to sell the stock at the strike price before expire. Maximum profit very high, okay, but limited. The stock can only fall to zero. Okay, which means that the stock can only fall to zero. So profit is actually the strike price minus premium. Okay, so later on with example, you will be able to understand what will be the maximum profit for a long pool. Maximum loss is actually limited to the premium that you actually pay for the put option. Same as the so-called the same as for the long call option, okay, the maximum loss will be the premium. Why you do this, okay, is to speculate on a price drop with limited risk, or to not so sure the stock that you own against a price decline. Okay, so for example, when you actually own a stock, you worry that you will further drop. So basically, you put this long put, okay, to actually ensure your so-called your stock that you actually buy, to provide some form of protection. Okay, so let me give you an example so that you can fully understand, okay, on the long pool option. Okay, so buying a pool option on DBS, again, the DBS will be the underlying asset. Okay, same thing. Okay, let's say that the current stock price is at 55. Okay, the put option purchase, okay, you buy a put option, okay, with a strike price of 53, okay, for a premium of $1. Okay, the option actually expire in 14 days. Okay, so basically, if you still remember, when you actually do a long put, you think that the share price will drop significantly, then you actually want to buy this long put option. Scenario one, okay, which is the price actually dropped to 48. Okay, from 55, it dropped to 48. Okay, so at expire, okay, you can actually exercise your right to sell this DBS share at the 53 strike price that you actually agreed. Basically, this is you buy the 100 share, which is the contract size on the market at $48. So you buy this at $48. immediately you can sell them at your strike price. Okay, so basically from here you can see that you actually buy from the market at $48 and immediately you can actually sell them at the strike price of 53 because you actually agreed to sell at 53. So therefore you can see that the gross profit per share will be equals to the 53. Okay, basically this is actually the strike price that you actually agreed minus away the actual price, which is 48, which means that the intrinsic value is $5. How to calculate your net profit? Okay, will be the intrinsic value minus away the premium. And again, you probably can earn $4 per share. Okay, so basically this is an example on the long put option. Scenario 2, the stock price stay above $53. Okay, so if the stock price is at or above 53, okay, upon before it actually expire, okay, so it is not profitable to exercise the option. Okay, you will let it so-called expire, so your total loss is actually limited to the premium that you actually pay, which is $1 per share. Coming to the break-even point, okay, the trade between profitable and expire when the stock price move below the strike price minus the premium pay. Okay, the strike price, let's say for this case is 53, minus away the premium, which is 52. Okay, so this means that you actually will be able to make a profit if the DBS share actually trade below $52, okay, before it actually expire. This will be a quick summary, okay, on the long put option. So imagine this, the DBS current price is at 53. You actually has a strike price. Okay, so basically you buy this long put is because you feel that okay, the market is actually bearish, the price will drop significantly. So basically you strike a deal, okay, with the buyer, okay, that you want to sell it at $53. The premium that you actually pay is $1. So the break-even point will be the strike price minus the premium. Strike price is 53 minus 1. Okay, this is actually the break-even point. Okay, so when the share price actually drop more than 52, then you will start to make profit. Maximum profit, okay, will be equals to the strike price minus the premium. Okay, so basically the stock can only fall to 0. So the maximum possible is your strike price minus the premium, okay, which is so-called 53 minus 1. So the 52, okay, per share will be your maximum profit. Maximum loss, okay, you actually can walk away. So therefore, your loss or maximum loss is actually limited to the premium that you actually agreed to pay, okay, which is $1. Intrinsic value, okay, when the share actually drop from 55 to 48, okay, will be the strike price minus the stock price. Okay, so the strike price is actually 53, the stock price is actually 48, so you actually has a $5 of intrinsic value. Net profit, okay, let's say the stock price currently is at 48. Okay, how to compute will be the intrinsic value minus away the premium, okay, which means that your profit is actually at $4 per share when the share price actually dropped to $48. Okay, so with this, okay, I hope you have a better understanding what is actually long pool. So what is actually a short call? Okay, coming to the action is basically you sell a call option. How about the outlook? Okay, you feel that the share will be bearish or neutral. Okay, so you believe the price of the underlying asset they will stay the same or even fall. Your right and obligation. Okay, so you have the obligation to sell. Okay, so this is for short call. You have and you must have the obligation to sell the stock at the strike price. Okay, so let's say if later on the buyer actually exercise their right. Okay, I will have an example for you to understand this. Maximum profit. Okay, so basically the maximum profit can be limited to the premium that you actually receive for selling the call. Okay, so basically this is in terms of premium. Okay, most of the time you actually can secure the premium. Okay, so the example will explain everything. Coming to the loss. Okay, so this is something that you need to know before you commit. The maximum loss is theoretically unlimited. So this is very scary because you can potentially have unlimited loss. Okay, because the stock can keep on rising and rising, and thereafter you are so-called forced to sell the share at a very low strike price, and you actually so-called sustain quite a big loss over here. So why you want to do this? Okay, so basically this is to generate income from the premium. Like I mentioned earlier on, the premium is almost guaranteed. So therefore, you actually can generate some form of income from the premium. And this is often done as part of more complex strategies like a cover call. Okay, so later on, I will explain what is actually a cover call. Coming to the example here. Okay, so the example is actually write a cover call on DBS. Okay, so this DBS is the underlying asset. Okay, very important setup for this example. Okay, I need to assume that you already own 100 shares of DBS purchased at the price of $55. Okay, so this is what we know as a cover call, okay, which is a very conservative short call strategize. Okay, so this is one thing that I need to assume, okay, but you may not need to have 100 share of DBS before you commit into short call option. So therefore, this is very risky. But for this example, okay, I just assume that you already own 100 shares of DBS. Okay, basically you purchase at $55. Okay, so now the current stock price, let's imagine this. The current stock price now is at $55. Then you went in to buy 100 shares of DBS now. So the call option so is actually you have the obligation to sell, okay, a call option with a strike price of $57. Okay, so basically let's assume that the strike price is $57 and the premium is $1. And the option actually expire in 14 days. Okay, so there are actually two types of scenario. The first scenario, okay, the stock price actually rise. Okay, from $55, it rise to $62. Okay, so before it actually expire. Okay, so with this, you are very sure that the option buyers, okay, will actually exercise their right. Imagine this short call, okay, and long call, they are like a pair. Okay, so when the price actually rise, okay, the buyer will exercise their right to buy. Okay, so therefore you have the obligation to sell your 100 share at the strike price, which is $57. Okay, so therefore, in short, you can imagine this, you are forced to sell your share at $57. Even the share price now is at $62, okay, but you cannot so-called sell the share at $62. You are forced to sell your share at $57. Okay, so this is actually the strike price that you actually agreed. Okay, so therefore you are actually forced, okay, to reduce your profit. Okay, just from 62, you are forced to sell it at 57. Okay, so therefore from your profit is actually the 57. Okay, so this is actually the strike price, okay, minus away the price that you actually paid to buy the share, okay, which is $55. So from here you can see that your profit become only just $2. Okay, not really $2. Okay, later on I will explain. In fact, the profit is actually $3. But from here you can see that, okay, so instead of $3, okay, so now you can see that the price actually increased to 62 and you actually buy the share at 55. So from here you can see that the profit technically should be $7. Okay, however, with this option, okay, so instead of $7, your profit become $3. Okay, so basically this is why for this case here, you actually make a loss. Okay, because instead of the $7 that you make, okay, you actually become just $3. Okay, so like I mentioned earlier on, most of the time your premium, you actually can collect it. So you actually collect $1 for the so-called premium. Okay, so the total net profit for you will be the $2. Okay, because you buy the share at $55 and this is your strike price. And therefore, this strike price minus the price that you actually pay for your share is $2. So this is actually your profit and plus the $1 premium, which you are allowed to keep. So therefore, from here, you can see that you actually make an earning of $3 per share. But if you don't have this option, okay, so basically you are going to have so-called 62 minus 55, you are going to have $7 per share. So therefore, you can see that you didn't make as much as profit once you have this option, but the price actually rise to $62 for this case here. Okay, so note, you miss out on the full gain above $57. Anything more than 57, you actually so-called didn't enjoy the benefit anymore. Okay, but you keep the premium, okay, which is $1 as consolation. Okay, so your profit is actually kept. So from here you can see that the maximum profit you can actually do, okay, basically they are actually kept, okay, from this example here. Your strike price, okay, plus your premium, that will be your profit if the share price actually increase so-called drastically. So basically this is a first scenario. Second scenario, okay, so earlier on I mentioned that the stock price actually rise to 62. So for this case here, okay, so imagine that the stock price remain below $57, okay, at expiry, okay, which means that there's no possible reason that the buyer will so-called execute the right. Okay, so therefore the buyer will not exercise this, and therefore the option expire. Okay, so in short, over here you can imagine that you continue to hold your 100 share of DBS. Okay, you continue to own this 100 share of DBS, and your profit is basically you collect the $1 premium. Okay, so this is actually your profit. Okay, so this premium is yours to keep regardless of the stock performance, as long as it stay belongs the 57 strike price. So from here you can see that you actually can collect your premium, okay, as long as the share remain below 57. Okay, so this is actually the advantage of short call option. Coming to the break-even point, okay, so from here you can see that, okay, the calculation is for the entire cover call position, okay, which include your existing share. Okay, so your effective cost for the share is reduced by the premium you actually receive. So from here you can see that the break-even price, okay, so this is the price that you actually buy to, so-called to buy the share, okay, minus away the $1 here. So from here you can see that, okay, 54 is your break-even. Okay, so let's say the price drop, okay, or even rise, you can see that this is actually your break-even point here. So 54 is the break-even point. Okay, so this means that if DBS falls slightly to 54, the premium that you collect offset the loss of the share and your break-even on the overall position. Okay, so basically this is on the short call. Okay, so a quick summarize here. So this is the example that I mentioned on this short call option here. So the strike price is actually 57. Okay, the premium is actually $1. The share that you actually bought, okay, the cost is actually $55. So your break-even point, okay, so basically you can see that the break-even point is your share cost, okay, minus the premium, okay, because you buy the share at $55. So this $55 minus one, this will be your break-even point. Your maximum profit, okay, basically the formula to calculate your maximum profit for this short call is the strike price, okay, minus the share cost, okay, plus the premium. Okay, so the strike price is 57. Okay, the share you're going to own is the share cost is actually 55. So 57 minus 55, which is $2. So $2 plus the $1. So this is your maximum profit. Okay, so in short, okay, your maximum profit is the strike price minus the share, the so-called the $55 that you actually buy the share. And from here, you can compute that this is your maximum profit. Coming to the maximum loss, okay, the loss can be unlimited, okay, on the share, okay, if the price continue to fall and fall and fall and fall. The premium only provide a very small cushion, okay, because it's just $1. It only provide a very small cushion, but technically the share can be continuous drop. Okay, so therefore with this, you can see that it's quite significant. Okay, if let's say the stock just suddenly crash. Okay, coming to the calculation on profit at $62. Okay, so therefore your strike price is 57. Okay, minus away the share cost. Okay, so basically this is 55, and then you plus the $1. So therefore from here you can see that even the share price go on and on and on. Okay, you cannot enjoy the benefit anymore. Okay, because okay, you are going to so-called constrained by the strike price, constrained by all this. So technically for this case here, you can see that the profit is $3. Okay, even this price, let's say 65 or 70, 80, your profit will be still just $3. Okay, once you have this short call option. Next on the profit, if the stock is actually below 57. Okay, basically if the stock remain at 57, you simply can earn the premium, okay, which is $1. Okay, so basically this is a short call option. Okay, so guys, okay, before I go into short put, I need your help. If you understand what is actually short call from this video, I urge you to support me by like this video. Guys, just give me a few seconds. Press the like button now. Okay, for those who are new to this channel, again, if you want to encourage me, please consider to subscribe and turn on your notification bell. Once again, thank you so much for strong support. Okay, so basically, let us quickly understand what is actually a short put. Okay, so earlier on, I have mentioned about the short call. Okay, so now I'm going to explain what is actually a short put. Okay, so the action is actually you want to sell a put option. On the outlook, okay, you think that the share probably will be bullish or neutral. Okay, so you believe that the price of the underlying asset, they will still stay the same or even rise. Okay, so this is actually the outlook for short put. You're right, an obligation. Okay, so as long as it's a short, okay, which means that you must have the obligation. Okay, for this case here, you have the obligation to buy the stock at the strike price. Okay, so if the buyer actually exercise their right. Okay, so again, I'm going to have an example for you to understand this. Your maximum profit, okay, so your maximum profit is actually limited to the premium you receive for selling the put. Okay, so later on, like I mentioned, example will tell everything. Your loss, it can be very high, okay, but limited. Just now will be potentially unlimited because this stock can technically fall to $0, which means that 100% whatever cost that you so-called commit, everything all go to zero. So this is actually your maximum loss. Early on, the price can be quite scary. So basically, this is your loss, which is your strike price minus away the premium. Why we want to do this short put? Okay, firstly, is the simple way is to generate the income from the premium. Okay, so or to buy a stock at a discount to its current price. Let me give you an example. Again, I'm going to use the DBS example for you to understand this. Okay, so now the stock price of this DBS is at 55 and you commit this put option. Okay, so you're going to commit this put option. Okay, so basically you sign this put option with a strike price of $53 and you are going to collect a premium of $1. So the option will expire in 14 days. So again, there are actually two types of scenario. Okay, so for this first scenario, imagine that your stock price actually fall and it actually fall from 55 to 48. Okay, for this case here. Okay, so the buyer will definitely exercise their right to sell. Okay, because now the price actually dropped quite scary, and the buyer actually want to so-called sell the shares, okay, at $53. Okay, so basically the buyer will definitely do this, and then after you actually have the obligation to buy the share. Okay, so basically the 100 share is actually the contract share of the DBS at the 53 strike price that you actually agree upon. So imagine this, now the share actually dropped to $48. Okay, but when you actually execute this short put, okay, you have no choice. You have the so-called obligation to buy this share at $53, okay, which means that you buy at a higher price because we are very sure that the buyer will actually exercise their right to sell. Okay, because the share price actually dropped, they will be definitely feel better to sell the price at 53 rather than at 48. So therefore, they will exercise their right. But for this case here, you actually need to have the obligation to buy all these 100 share at 53 strike price, which means that you actually buy at a higher price. So from here, you can see that you are actually forced to buy the share at $53. The market share for this case here is just only 48. So your immediate paper loss is actually 53, okay, which is your strike price, minus away the 48, okay, which is the current market price. So from here, you can see that immediately you actually commit a loss of $5. Okay, but I always say this, when you actually have this short, okay, the premium is actually for you to keep. So therefore, you actually have a dollar of premium. So therefore, from here, you can see that your net loss is actually $4. Okay, so basically, this is what is on short put option. Okay, so note, okay, so now you actually own the 100 share of DBS with an effective cost basis of 52. Okay, because the strike price is 53, you earn a dollar. So basically, this is actually the effective cost basis of $52. Okay, which is the strike price minus away the premium dollar. So you are holding a loss until the stock price actually recover. Okay, so you must wait until the stock price actually recover more than 53, then you make profit. Okay, so basically this is what is on the short put option. Another scenario, earlier on, I talked about the scenario that the price actually reduced from 55 to 48. Another scenario, okay, basically the stock stay above 53, okay, because 53 is actually your so-called your strike price. Everything rosy stay above 53 at before it actually expire. Okay, so the option expire worthless. Okay, the buyer has no reason to force you to buy share at 53. Okay, they won't ask you to buy the share at 53 when they actually are cheaper on the open market. Okay, so basically this is another scenario. So the stock price, can remain above 53. Okay, so the buyer will not force you to buy the share at 53, okay, when they are actually cheaper on the open market. So you do not have to buy any share. Your profit is the entire premium that you actually collect, which is $1. So therefore, from here you can see that the short put option, okay, the premium is actually the pure profit for taking on the obligation. Okay, so basically from here you can see that you probably can earn the premium for this particular case on this short put option. Coming to the break even, okay, so this is the point where the loss on the assignment share is exactly offset by the premium that you actually collect. Okay, so basically the break-even price is actually this. This is actually your so-called your strike price. Okay, so this is always for short, you always earn the premium. Okay, so your break-even price is 52. Okay, so if DBS is above 52, then you make a profit. Okay, up to the maximum of $1. Okay, if it's above 53. Okay, but you actually will, if let's say this DBS actually drop below 52, okay, you start to incur a net loss. Okay, so why? Okay, because you actually have a strike price of 53. Okay, so basically you have a premium of $1. So if the DBS drop less than 52, okay, then you will start to having a loss. Okay, for this case here, if the DBS is actually so-called rise, okay, to more than 52, but from here you can see that your profit is just a maximum of $1, okay, if it's just above this 53 strike price here. Okay, so a quick summary of the short put example here. Okay, so basically the strike price for this case is 53. The premium is $1. Okay, coming to the break-even point will be your strike price. Okay, because you are covered by the premium, this is something that you actually will have a so-called a profit. Okay, so you are actually covered by the premium. So therefore, you can see that the break-even point is actually the strike price, which is 53 minus $1. So which means that the break-even point is 52. Okay, so basically this is a break-even point. Your maximum profit, okay, basically will be just on the premium, $1. Your maximum loss, okay, will be 53, which means that your share price go to zero. Everything go to zero, which means that, okay, your possible net loss per share will be 53. Your net loss at 48. Okay, for this case will be the strike price minus the stock price minus the premium. Okay, so the strike price is actually 53 minus the stock cost, okay, your stock price, which is 48, and minus away the premium, okay, you can see that this is actually your loss. Okay, so this is strike price 53 minus 48, okay, which is $5 and minus $1 off the premium. This is your loss when the share price actually reduced to 48. Okay, so this can be very effective cost, okay, if assigned. Okay, so basically it's a strike price minus a premium. Okay, so basically this is so-called a protection. Okay, so later on I will explain some form of protection. Okay, so now I'd like to explain why people want to use this option. Okay, people and institution actually use this option for several key reasons. One is to leverage. Okay, so from here you can see that just a very small amount of capital, okay, which is the premium, okay, you can actually control 100 shares of a stock. Okay, so this is why it is very attractive to use this option. Okay, because you potentially will lose the premium. Let's say for long call and long put, okay, potentially you will be losing your premium. But over here, you can see that you actually can control 100 share of stocks. Okay, so this magnifies both potential gain and also the loss. Coming to the H, okay, is also provide a form of insurance. Okay, so this is a primary use. Okay, so imagine this, if you own 100 share of Apple stocks and are worried that at short term, the price will drop. Okay, so therefore, you buy this put option to cover you. So if the stock actually fall, the profit, okay, that the put actually will help you to offset the loss on your share. So therefore, it actually act like a form of insurance policy. Okay, so next is actually to generate income. I mentioned earlier on, okay, you can actually sell an option against the stock that you own, okay, to collect the premium. Okay, so this is actually a strategize that is known as a cover call. Speculation, okay, basically for normally when you just buy the so-called the share, okay, the only way that you make money is when the share actually increase. But for this case here, okay, you can have some form of speculation. Okay, you can actually bet whether is it rising or is it falling. Okay, so and also if you actually use this option, you don't really need to buy the stock itself. Okay, so basically this is why people will use the option. Next, I just want to do a quick so-called summary table to discuss on long call and short call. Okay, on my previous video, I have actually discussed on long call and long put, but over here, you can see that, as I mentioned earlier on, long call and short call actually like a set, like a couple like that. So basically for long call, okay, the outlook is actually bullish. For short call is actually for bearish. Okay, so for this case here, for the long call, you actually have the right to buy. As for short call is you have the obligation to sell, which means that you must sell. Okay, so the maximum profit is unlimited. Okay, so basically the limit, the so-called the profit that you actually can make from long call is unlimited. And the possible maximum loss will be the premium that you actually pay. So therefore, it is much more safer to back, okay, with long call. As for short call, okay, you can see that your maximum profit probably will be the premium that you actually receive. Okay, but you can see that your loss can be unlimited, which is quite severe for this case here. Coming to the long pool, okay, basically for long pool is you think that the market outlook will be bearish. For short pool is you think that the outlook is actually very bullish, okay, and also very neutral. Okay, so for this case here is you have the right to sell. Okay, for long pool, you have the right to sell. Okay, so basically the maximum profit can be very high, okay, up to zero. So when the share price drop to zero, this will be your profit, okay, because you have the right to sell. Okay, so basically the loss is again will be the premium that you actually pay for. Okay, coming to a short put over here. Okay, so basically the loss, or sorry, the maximum profit is actually the premium that you actually receive. Okay, let's say for this example will be very just $1 on the premium. Okay, but the maximum loss can be very high when the shares actually drop to zero for this case here. Key takeaway: buying option long give you the right, and your limit, your risk is limit to what you pay. Okay, for example, you want to commit certain amount, let's say $1,000. Okay, so basically this will be your maximum loss, the $1,000 that you actually pay. Okay, coming to the selling option here, which is the short. Okay, so this actually give you an obligation. Okay, and your risk is higher or even unlimited, while your profit is limited to the premium that you actually collect. So therefore, you need to fully understand, okay, the key difference between long call, long put, short call, and short put before you commit into investment. Okay, so with this, I'd like to end my discussion. Please help me to like this video and subscribe to this channel. Once again, thank you so much for strong support. I hope to see you guys soon. Bye for now. Thank you so much.